Well, here at the Hidden Money Podcast, we have a good wedding gift for you. We're going to talk today about life changes. So the wedding bells rang, or maybe you welcomed a new baby into the world, or maybe you got a divorce. Maybe it's not so sunny right now, and you got a divorce. It happens. It's happened to me. I can speak a lot to kind of divorce tax planning in a morbid way, but I mean, life happens, right? I mean, people get married, people pass away, children are born,
spouses pass away.
Those are a lot of life events that happen that we don't plan for necessarily. They just kind of happen. Now, babies don't just happen. Weddings probably don't just happen unless you go to Vegas or something. Typically, you're planning these things. Now, death is a different thing, and divorce typically takes a long time. So in all these instances outside of death that could be instantaneous, everything typically you can kind of see coming up. So if you have any big life events happening, it might not be a bad idea just to sit with your CPA and discuss what changes am I looking at on the tax side, financial side, insurance side. I mean, there's so many things you can tackle during a life event.
Yeah, I mean, there's more life events too. You get a higher paying job, you lose your job. I mean, life events happen. That's one guarantee in life, right? Yeah. Change is happening whether we want it to or not. It's always going to happen. There's a tax side to those things. And if you don't do it right, and you're not planning to understand tax strategy, not only are you going through changes, some of them very unpleasant. Like I was with you during your divorce, and that sucked for you.
Yeah.
At least you didn't overpay your taxes during that time. But someone else, don't get a double gut punch, man. Focus on tax and don't be stuck paying a huge IRS bill that you didn't even know.
Yeah.
So.
Yeah, and you know, in the event of a divorce, it's typically everything's kind of, you got to have a good attorney, right? And we're not attorneys. I'm not licensed in any way, shape, or form to give legal advice, financial advice. This is just my opinions and my
Always
opinions
consult
only.
your own attorney.
Consult your own professionals. If I'm your professional, then I'll help you out if we're engaged. But when I was going through my divorce, and how divorces typically are done is, depending on what state you're in, you got community property in play. We're in Texas, so it was community property, so everything was split 50-50. We earned income majority together through the whole year, so we split our income on our own individual tax returns. I took my income, she took her income. We agreed to do that. But there's a lot of things now that you can get creative on, like, now alimony is not deductible. Child support's never deductible. Sorry, guys, but your child support, you're going to be paying for the care and well-being of your kids, and you're going to pay tax on that as income. You're going to earn that as income, and it's probably going to go directly to the Attorney General in the state you're in, directly from your employer. You're not going to even see that cash if you're a W-2 earner. It just goes straight to the Attorney General, which then goes to the care of the child.
What if you're self-employed?
You still have an obligation to remit your own
through
taxes.
State.
Yeah, through the state. So yeah, you're going to get a set amount of child support. That is not a tax deduction, unfortunately. You are actually going to get hit pretty hard because I pay tax on my child support. That's income to me, even though I don't see it. It's so weird. I did see that Trump was tossing around possibly letting the person paying child support claim that child every year on the taxes, which would make sense. I mean, the financial support is coming from one side, but I mean the other party is probably picking up some expenses too. But
how is it handled then if Trump's new supposed law doesn't come into effect? It's handled in a divorce decree, right?
Right. It's just a negotiation. So we went to mediation. Not all divorces go to mediation. Some actually go a little further, or they might not even make it to mediation. They just agree, hey, this is what it is. We're going to put it on paper and sign it and run it through a judge. But we went through mediation, just agreed, we're going to do odd and even years, right? So we had one child at the time, and so not at the time, we still have the child. But at the time of divorce, we had one child, and so we didn't have, if you have two kids, one can take one and the other can take the other on their taxes every year, and it's pretty easy. So it's all negotiation. We just did odd and even. So
let me just throw in a lot of cases though, that's not the net best benefit for the divorced parents and the kids, because the IRS can get more money. A lot of cases we have one spouse who's going to be the owner. He's paying some kind of alimony in some cases, or she is, and they're paying the child support. And if they split the tax year, or they split the who gets to claim the kids, even odd. Well, the year that the spouse that's not earning a lot gets the kid, guess what? The IRS gets a lot more taxes paid that year than if it was the other way around. So I would think, and I haven't gone through a divorce, thank God. Becca, please don't ever divorce me. But I would think that's a reasonable negotiation, is you're trying to divvy up your estate and split all the assets. Like, hey, if we'll get to keep more money and the IRS will get less if I can keep claiming the kid each year, or vice versa for a different spouse. So maybe you get a little bit more of this or a little bit more of that. Like, that's, most divorce lawyers probably don't even think of that. So you ought to bring in your tax strategist or a tax advisor at that point in time before you doing your negotiation. Figure out what's the best thing to do.
Yeah. And I remember when I was going through mine, I was in my late 20s. Maybe was I early 30s anyway. I was young. And we had a house, but we were really living pretty thin. Like, we had a mortgage payment, car payments. We were trying to get out of debt and all this stuff, starting my career. And basically I was contributing to my firm's 401k at the time. So I think I put in, through the course of our marriage, maybe 20 or 30,000, I forget, into this 401k when I was working. Well, that was a community property estate. We were married, and I was contributing money out of my work, my employment, not hers, but my employment at the time. That is community property. So I put in, let's say, $30,000 into a 401k of my employer's. Well, that needs to be split. Well, I didn't want to, liquidate the account and then pay penalties, or not penalties. It would just be a direct transfer. I didn't want to do that. So what I did is, she wanted cash. And so I'd go, okay, why don't we structure it? I'll pay you what's called alimony. And alimony at the time was deductible. So I said, I owe you $15,000. I owe you half of this account. I'm going to pay you an alimony. I got to deduct it, and she had to pick it up as income. They didn't think about that during the mediation. Like, why are we coding? Why did she care if it was considered alimony or what? I mean, because it was considered alimony, I got a tax deduction for that money I had to pay her, instead of doing a direct transfer from my 401k to her 401k and just moving 15 grand.
Liked it because she would have had to keep it in a 401k and she couldn't have accessed it.
Yeah, so I kept the whole retirement account and just paid her half of it, and I classified it as alimony in the decree. So I paid her alimony even though we were only married a few years. So, I just got, that was a very small example with a very small amount of money, but I thought it was kind of creative at the time. And I was like, hey, all right.
Like, this sucks. I'm going through hell, but at least I get a tax deduction.
I get a tax break on $15K.
It does help a little bit.
Yeah.
Not a lot.
Yeah. So a lot of times I've helped clients go through a divorce. We'll sit down. I sat down with a financial advisor. I just did one last month. High net worth people, they had me, the financial advisor, and an attorney. All three of us were on the same page, same email, same text thread even. We're all together on it. But the financial advisor put all the assets on paper. And then I came through with my opinion on, hey, tax advantage. She was receiving an annuity. He was semi-self-employed, but he had stock in a company that was going to appreciate. So they had these different guarantees. Like, he was in a risky business that had a lot of upside. She had this stable annuity coming in. Who's keeping what and why? So helping them navigate that, and then filing your tax return. So you are, at the end of the year, if you're going through a divorce, depending on what your marriage status is on December 31st, that is what classifies your filing status. So you could be separated, you could be living in different houses, but until you are legally divorced as of December 31st, you're going to be filing a joint return or a joint married separate return. Which is an uncomfortable situation if you're already getting divorced. Too.
Yeah, if it's contentious. And suddenly you're relying on your contentious, used to be better half to figure out how to file your taxes. Married filing separately. I understand some cases it's needed, but boy, that's almost always the worst tax impact.
Yeah.
Like, that should be your last resort.
Yeah, it's expensive. You're filing 2 tax returns.
You're paying much higher tax rates, effective taxes, you generally speaking.
And if you're in a community property state, you're splitting it anyway, unless there's a prenuptial agreement or some sort of agreement of separate property in a community property state. That's what the attorneys and CPAs, that's what we work together on. So you have the financial advisor, the CPA, and the attorney all working on either one party's behalf. Hopefully each party has their own team, depending on, the level of advice needed. But just do not go at it alone. It is very hard, and you just need people watching every aspect of the divorce.
So I know it's a painful time, but and in some cases you're just trying to survive, and that's fine. Okay, ignore tax, pay more tax.
Yeah.
there's a time for that. But if you can, get tax advice, get financial advice. Don't just go do it. I've seen all too often, usually it's with clients that already were divorced before they come on, and I'm going over their stuff, and man, they're in a bad tax position. And I ask them, did anyone tell you that you could have done this or that? And they're like, no. And they're paying a lot more in tax, or have paid a lot more in tax. So get some advice, get some help. As Kevin and I push all the time on hidden money and with our client base, you got to build a team. Get a board of advisors, get advisors, financial planner, tax advisor, generally a CPA, but remember, not all CPAs are equal. Some are just tax preparers. Get a tax advisor and your attorney, obviously.
Yeah. But if you just heard wedding bells, this might be a joyous occasion.
I'm glad we got the divorce thing out of it, because that was really morbid and sad.
Well, should we just do death next then and just keep this train going?
No, let's get some nice stuff. Let's talk about a happy wedding bells.
Wedding.
You're engaged. You're in love. You're doing your honeymoon.
You're holding
stuff.
hands in on our office.
Your spouses are perfect in your eyes. You haven't figured out that your wife is a sinner yet. That's the beautiful time. Happy time. Let's go there.
Yeah, your husband hasn't left dirty underwear on the floor or in the bathroom yet. Everything's good. So everything's great. Congratulations. Yeah, there's tax planning to be done even then. So y'all go together. If y'all each had your own CPAs, which is very common too, we lose clients because of this.
Yes.
They maybe the other spouse or the new spouse has more of a complex situation that's with another tax preparer already, and it's just easier because there's a lot more history with the more complexity there. But y'all make the best decision on what you want to do. But
work together.
If, let's say you're both, here's a big trap. If both of y'all are W-2 earners, which is probably the majority of people, that y'all just have W-2 jobs, you don't have kids yet, maybe, and y'all are just working. If one spouse is higher income than the other, they're used to withholding at their tax tables, assuming their withholding calculator's right, which is always hard. But let's say they're withholding exactly what they should. Then you enter the picture, and let's say you make less, or let's say you make even more. You're withholding at what your tables are. Well, when you file jointly, you're combining your income together.
You're getting different tax brackets.
With now your withholding tables are messed up. So in that first year of marriage, you could see either over withholding or under. I see it more under than over. So just be careful if you have a disparity of income that you're rerunning y'all's income together with the CPA saying, okay, here's what my annual salary is and bonuses. Here's what hers is, salary and bonuses. Put it together. Here's our anticipated withholdings for each. Just run that through a projector software in an hour, and you will know if you're over and under. And then if it's not too late, you can change your withholdings now. If you know the wedding's going to go through and you're going to be legally married by the end of the year, get ahead of this withholding trap that you could find yourself in.
If you don't do it, the end result is you've way overpaid your taxes, which means you gave the government an interest-free loan, and you get a big refund eventually, but that was your money you could have been using the whole time. Or on a more painful side, you were way under withholding, and suddenly you guys are happy, you're in love, and your tax preparer calls and says, guys, you owe $15,000 on April 15th. You got any money for it? And probably not, because you're not saving when you're married. You're doing fun stuff. You're like, this is fun.
The honeymoon costs $15,000. I don't want to pay the government $15,000.
Right.
So, be ahead of it.
Yep, definitely
100%.
get ahead of it.
Yeah, and are weddings tax deductible? No. That is a personal expense, unless...
If you can find an argument to make it an ordinary necessary business expense, there is a way.
Everything is possible.
Yes.
Everything is possible. So if you own a wedding venue, perhaps maybe you can, we do actually have clients that own wedding venues.
Get some tax deductions and even the research and development tax credit.
Yeah. Get some deductions. Have your own wedding at your own wedding venue. Pay your own caterers. Hey.
Yeah,
there might be a way to actually make an argument. No, for 95%, 99% of the populace, your wedding is a personal expense. You're not getting a tax deduction. But for maybe that one person out there, you might find some hidden money in deducting your wedding, so long as it's ordinary and necessary for profit motive in your business. And may not have any idea about the world of taxation of being self-employed. So education.
The hidden thing is usually it's a surprise. People aren't thinking taxes when they're falling.
It's not a good hidden surprise.
Don't be surprised by it. Plan for it. You're now two are becoming one when you get married. You've been filing your own taxes. That's going away. You have to file as married. You can file married filing separately. 999 times out of 1,000. That's a bad idea. You're going to be filing a tax return together on one tax return. Plan for it and enjoy your marriage. Don't get a bad surprise.
Yeah. Then let's say the wedding is over. You did your tax planning. Your withholding is good. Maybe you're going to welcome a baby into the world soon after.
Congratulations.
Congratulations.
That tends to happen that way.
Yeah, it should happen that way, huh? Well, a child brings, everyone always knows about the child tax credits, and depending on your tax brackets, you could have different credits tied to it, but more than likely you're going to get a good I think it's $2,000 of under this current law of child tax credit, and it goes by the end date of the year, just like your marital status, December 31st. If your child's born before December 31st at midnight, you get to claim that child.
Here's a
in
hidden
that
money
tax
nugget.
year.
Kevin did this right. Plan your family planning so you have your baby in December. Because what you get is you get a whole year's of tax credit, but you only got to pay 1 month for the baby, and babies are expensive.
Yeah.
So have your baby late in the year.
Yeah. And also, later in the year, you probably already met your medical deductible, which was the case for us too, is because I got 2 other kids. So now when we welcomed our son, and my son Guy here, he is awesome. He was born right before Christmas, December 23rd.
Nice.
So we actually spent the night in the hospital on Christmas morning. But we have 2 other kids. So having 2 other kids and a wife and me, by the time it seems like March rolls around, I hit my medical deductible with these kids.
So you had a baby for free, basically. Medical insurance covered for once.
I had like $150 like hospital fee or something that wasn't covered.
It's like a $9,000 bill, and you paid $150.
Yeah. And so watch your medical expenses, because if you can have your baby, at the December 31st, you already probably hit your deductible, and you get the tax credit.
Okay, but in the real world, our babies come when they come, or they don't come when we want them to, for sure. So
yeah,
let's get back to some other stuff on it. Education. My kids are still pretty young. My oldest is 8. My youngest turns 2 in a couple of weeks. I got a lot of time to plan for college. But I've learned it from my clients' hard lessons, the ones that don't plan, and suddenly they're shelling out tens of thousands of dollars a year to get their kids into school. What are some things you got to think about?
Well, for education with children, you have a lot of options for you. Actually, if you're self-employed, here's a cool trick. You can actually tax deduct some college, some primary education, as long as there's some sort of work for these children, meaning they can sweep a floor, they can manage socials, they can serve coffee at your office. There needs to be some substantiation of work for the child, but if there is, you can pay them a salary out of the business, put it into their checking account or their own checking account. From there, you could put it into a 529 plan for their college. You could put it into any other ESA account that grows tax-free, so long as it's for qualified education expenses. Then qualified education expenses could be private school. It could be a number of things. But that way, if there is a substantial amount or substantiation of work in the business, you can pay them as a salaried expense, lowering the parent's taxable income, then just paying the education expenses once it hits their bank account.
If you're self-employed too, and you got your children working with you, it's a good idea. You're going to probably be paying them allowance anyways. Get them on the payroll and teach them work ethic. But there's also education reimbursement plans, or tuition reimbursement plans that employers allowed to pay that is not tax deductible, that is not taxable income to the employee, up to $5,250 a year. That can be a deduction for you.
Expense.
Yeah. There's also that one too. You can pay the dependent care. These are all cafeteria plans. Don't just go out and do this. They're complicated. Make sure you work with someone that knows what they're doing, or an administrator for the plans. But yeah, you can also get your dependent care tax deductible out of the business if you do it right.
Yeah. And since I have 3 kids and you have 3 kids, I would assume our kids are going to be on the payroll doing stuff pretty soon. So sorry for
We don't need to hire any more people. We got 6 coming in.
True.
Yeah.
Sure.
There we go.
Yeah. Unfortunately, we're not going to have a generational business. I don't think my kids want to be accountants, but they can serve
How do you
coffee
sell
and
that to your
sweep. They can sweep a
parents?
floor or two.
So we were just doing this Bible study the other day, and we're talking about Matthew, the tax collector, right? And my middle kid says, "Daddy's a tax collector," and you were telling me that's
Yeah,
what
my
your
kids
kids
thought the same
think you
thing.
are. Thankfully, my older son realized I fight the tax collectors.
So after you have the child, life goes on. There's a lot of in between. Job loss could be a big life event. Like you said, being promoted could be a big life event.
Yeah.
So what are some tax planning ideas in the event of a job loss versus being promoted? What would you recommend?
Job loss, especially if you've lost it like towards the second half of the year. You've paid in withholding taxes based on the assumption you're going to make that earning the whole year. So you probably overpaid your taxes. And then let's say 3 months later, you get a new job. Make sure you adjust your withholding. Don't do so just because I said so. Work with someone and do it wisely. Make sure you adjust your withholding because those 3 months or 4 months of unemployment made your annual income a lot less. You don't want to get withholding tax paid and taken out of your checking account or your paycheck to the extent that it would if you've been working all year, but that's what they'll do.
Mm-hmm.
So don't overpay the government. Think about that. There's other things to consider, but just talk with a tax strategist. We want to make this like a come to this podcast and learn everything about life changes, and you don't need to talk to a tax advisor. The problem is the facts and circumstances. Everyone's case is very different. You should consult with a tax advisor when something like that happens, even though that's the last thing you want to do when you just lost your job.
Yeah, and a lot of, if you were, let's say you're self-employed and your business is losing cash and you have to close your business, we add tremendous value on business exits, whether it's a sale or a wind down. There's so many things you can do. If you're bad at budgeting, let's say you're a W-2 earner and you lose your job, like Mike said, check out your withholding. Just run it through a calculator on the IRS website. It may not be the best, but at least get you in the ballpark maybe. But maybe get with an accountant. If, be careful of fees. I mean, if you just lost your job, you're probably not looking for more professional fees to scoop up. But if you're not good at budgeting, get someone in there that can help. Like Financial Peace University by Dave Ramsey. I think it might be $100. If you lose your job and you've never budgeted and every dollar for you counts right now, go to Financial Peace University, take that class, get a strong budget set up for your unemployment or for your current cash. Be looking for a job. Don't stay unemployed. Get back to work. And I know it could be hard, and depending on the market of the industry you're in, it could be very hard. But man, don't give up. Keep going, and do the next best thing, and just start to budget. If you've never budgeted before, no better time than now when you don't have the revenue and the income coming in. So that's not so much on the tax side, just from financial advice. Just Financial Peace University it hits so much of the population. We don't agree with everything Dave Ramsey says or does, but for the general public, I think it's a great. Gets you there.
He helped me a lot. He got me out of debt a couple times. Dave Ramsey did.
Yeah.
So he's good. Don't follow every bit of advice because it might not be applied to you, but it's great general advice.
Yeah, it is. So what about promotions? Let's say I worked hard at my job. I'm a $100,000 employee, and I've been kicking butt at my job, and my boss walks in, and I get a nice little raise. Let's say I go to $200,000. He's just so nice. I get a double my salary.
Yes.
What would you recommend now?
That's amazing. That's wonderful. I'd celebrate, but quickly figure out the tax ramifications. When you make a bunch more money, you have more opportunities for tax planning and tax strategy. You could actually get $100,000 to $200,000 pay raise. We're making 100, you got $100,000 raise, you're now making 200. And if you do this right, you can pay less taxes than you were paying when you were making 100, because now you have a little more disposable income. Use that to make good tax strategies, make good tax advantageous investments, lower your taxable income. I didn't follow this advice. When I got my first big promotion from senior manager, I was making a lot more money. I just spent it. And I paid a lot more in taxes. And I actually had a lot less take-home pay. The IRS loved me getting that promotion. Don't let the IRS get promoted when you get promoted. Yeah. Get promoted. Let the IRS stay about where they're at and start leveraging the tax code.
Yeah. Don't give them a cut. No, that's good advice, because you're working hard for your money. And like you said, when you have more disposable income, I don't think it's uncorrelated that a lot of wealthy people or people who make significant money, they spend more money on tax planners. They spend more money on attorneys for a reason, because we're providing a benefit to lower their taxes. Now, the wealthy still pay their fair share. I think you came across that statistic, I think a couple weeks ago, where there is a misunderstanding that the wealthy don't pay any tax. It's kind of Trump does not pay many tax because he was involved in real estate. With real estate, there's so much planning you could do to offset taxes. But the wealthy do pay their fair share.
You just look, and this is all over the place on the internet. Don't take our word for it. Go look at the facts. The supermajority of taxes are paid by the wealthiest 10%. The biggest piece is paid by the wealthiest 1%. The bottom 48% of income earners in the country don't pay any tax. The average taxpayer, 85,000 a year, about 85, I think, this year. Average taxpayer, 85,000. They're right in the median. Those people are paying all the taxes. They're paying a lot of tax. So the richest, they pay a lot. If you're not paying taxes, you're not going to get a tax cut. It's just, I'm just saying that. If you're not paying taxes, how do you get a tax cut? You're not paying tax
anyway.
Yeah, you already got a great tax cut.
I'm unemployed and I don't work. That's your tax plan. It's a terrible wealth plan, but a great tax plan is to not make money.
You're not paying taxes. So
that's great. So that covers a good chunk of life events, wedding, children, the unfortunate event of a divorce, pay raises, job loss. I mean, there's a lot of things that happens in life. One thing we didn't get to was when death happens.
Yes.
Death can be a very hard time.
But for the man who dies, he doesn't have to worry about taxes.
He doesn't have to worry about taxes. He tends to leave that burden to other people.
Yeah.
Estate planning, we're going to have one of our amazing tax attorneys on the podcast. We will talk estate planning. That is such a big well to go to that it's going to require its own episode.
Yeah.
But if you've encountered a death, if something has happened, my best advice is always don't make any major financial moves. You got to grieve. You got to get through that time. Don't panic. Don't freak out. If the spouse that handled the money passed away and then you never handled money, get that team around you. That's why the team is so important, is because they will help you.
Don't do it on your own.
Don't do it on your own. Don't worry about taxes in this season. I mean, there's things that we can do, but we need to plan for the death. Death is going to happen. We need to plan for it. So we will cover death more in a future episode, but I mean, life happens. And to reiterate, no matter what happens, just sit down with a CPA, have a discussion, even if it's for 30 minutes, 15 minutes, an email. It doesn't matter. Just say, hey, we're getting married. We're welcoming a child. What should I do? What do I do? And then let them take it from there.
There you have it. Life changes on Hidden Money. Please be sure to like and subscribe to this channel so you can learn all about taxes. Especially, we have a big new tax law coming in. What do you need to know? Make sure you subscribe so you can get the updates.